Good morning. Wishing you a wonderful Wednesday ahead. Welcome to today's episode of Morning Well. We'll talk about three things. Materials, the only sector higher for the day. Earnings from Target. And RBA reiterates, doesn't expect to raise rates until 2024. US stocks fell Tuesday in a choppy trading session as investors again pulled back from riskier assets amid a continuing stretch of volatility in both stocks as well as bonds. The S&P 500 lost about 0.8% while the Nasdaq was down 1.7%. The Dow was also lower by 0.5%. The dollar slipped against most of the G10 basket, although the yen was basically flat. Oil reversed course and fell while gold rose. Asian equity futures are higher. On Tuesday, the yield on the 10-year US Treasury note fell to about 1.41 from 1.44 on Monday, a drop that marked 3 consecutive sessions of decline. Even so, it was not enough to appease stock investors. The S&P 500's material sector finished Tuesday as the only one of the index's 11 groups to end higher, rising 0.6%. The information technology sector, in contrast, suffered the steepest decline of the group, losing about 1.6%. Among individual stocks, Apple lost about 2.1%, Twitter dropped 5.1%, Microsoft was also lower, 1.3%. Still, there were bright spots in the market. Payments company Square climbed about 4.7% after it said its industrial bank had begun operating. Companies that tumbled sharply during last year's market rout also surged. Cruise line Carnival added about 4.9%. American Airlines also added about 1.2%. Investors and analysts expect an increase in consumer demand for travel services once larger swaths of the population receive the COVID-19 vaccine. On to some corporate earnings and results. Lyft said ridership was up for the third straight month and it expects to lose less money than originally forecast. HP Enterprise gave a bullish forecast for the current quarter. Profit excluding some items will be as much as 44 cents per share, topping the 38 cents average estimate. Coles beat on quarterly profit while the midpoint of its adjusted EPS guidance missed. Moving on to earnings from Target, COVID-19 helped Target Corp get much bigger. Target reported and erased earlier gains and fell about 6.8% after investors weren't impressed by the retailer's profitability outlook for 2021. Target said Tuesday that holiday sales rose solidly, capping off a year when the Minneapolis-based retailer increased revenue by more than it had in the previous 11 years combined. In the most recent quarter, net earnings hit about $1.38 billion, up 66% from a year earlier period. Earnings per share were at 2.67 compared with 1.69 a year earlier. Comparable sales, those from stores and digital channels operating for at least 12 months, rose nearly 21% in the fiscal quarter ended Jan 30th, boosted by strong demand for online services including same-day order, pickup and delivery. For the full fiscal year, revenue hit about $93.6 billion, a 20% increase. The chief executive said, following years of investment to build a durable, scalable and sustainable business model, we saw record growth in 2020. In recent years, Target has ramped up investments in online services instead of spending heavily to establish a massive network of online fulfillment warehouses. Target has used stores as a hub to ship online orders to allow shoppers to pick up their orders from store parking lots. Over the past fiscal year, around 95% of the sales came from store fulfillment, which includes products bought in stores as well as online orders fulfilled from stores. Digital comparable sales, orders placed online or through the Target app, more than doubled in the recent quarter. That model, as well as selling products in high demand during the pandemic such as home decor, food and toilet paper, helped Target grabbed market share over the last year. Target, along with many big box retailers, remained open in the early days of the pandemic, while department stores and apparel retailers had to close to in-store shoppers. Target said Tuesday that it estimates it gained about $9 billion in sales from competitors. Lastly, we spoke about the Reserve Bank of Australia's meeting yesterday. So the RBA left its cash rate unchanged at a record low of 0.1% during its March meeting, as widely expected. Policymakers said currently monetary policy continued to help the economy by keeping financing costs very low. The central bank also said it was prepared to make further adjustments to their bond purchases in response to market situations and reiterated that it will not increase the cash rate until inflation is substantially within the 2 to 3% target, conditions it does not expect to meet until at least 2024. Regarding the GDP, it is expected to grow at about 3.5% over both 2021 and 2022. In fact, we'll have the GDP numbers later today from Australia. That's the update. Stay safe and healthy, and I'll speak to you tomorrow.